Today is Thursday, June 25th, and you are looking at a daily chart of the SPY index. Today was a big day in the stock market. It was a flood of headlines and events, specifically in the banking sector. There are big, major development in the banking sector, and we're going to discuss them here in details. We're going to look at pre-market activities and headlines, and then we're going to look at activities that happened during the market and what happened post-market and what to look for tomorrow and next week. Here's a heat map of today's activity. Big day to the green, specifically at the end. There was a lot of buying at the end. The banking sector caught a bid early on in the morning and blasted to the upside in expectations of the Fed stress test that happened in the afternoon. Now, there are different outcomes that happen here, but the XLF closed the day up almost 3%. However, in the aftermarket, bank stocks dropped in the red because of the results of the stress test. We're going to take a look at that later on. Here are some important headlines from the morning. COVID cases yesterday hit a record high of 45,500. The pandemic is slowing down in a lot of places, specifically in Europe, but we're still dealing with it here in the United States. Here is a chart explaining which states are contributing to the rising number of infections. In California, Texas, Florida, Georgia, North Carolina, and Arizona. And here's another headline predicting over 180,000 cases by October. Certainly a grim prediction. Here's another chart of the United States versus the world in terms of infections, new cases. And you can see that the U.S. is curling back up while the rest of the world is trending down. We're also seeing a rising number of hospitalization here in my state in California. Cases are rising. They never stopped rising. And now we're seeing hospitalization taking back up. That is not a good sign for California and for the overall economy, that the largest state in the country is seeing a surge in hospitalization. Here's a tweet in the morning from the President of the United States, and he's attributing the rising number of cases to the rising number of tests, and saying that, hey, yes, we have new numbers in infections, but you can attribute that to the rising number of tests. Now, that is a false assumption, and here's a chart that shows you that even though that the cases are rising in many states, tests actually went down, specifically in Florida, South Carolina, and in states where tests went up, the positive infection cases trended higher, way higher than the percentage of tests. So this is not a correlation between rising number of tests equal more cases. This is a fact that people went out and about, and now we're seeing more infections in many states. Then we have the weekly unemployed claims. We're at almost 1.5 million this week, and for a total of over 19 million that are still claiming unemployment. It's not a V-shaped recovery. I don't see it. If it is, I can't see it from these numbers. Another interesting headline, the Treasury Department, the IRS, sent stimulus check worth over $1.4 billion to dead people. Meanwhile, there are about 30 million Americans who claim that they didn't receive the stimulus checks, even though they are eligible to receive them. So I guess these days, you're better off being dead than alive. Here's another headline that pokes holes in the V-shaped recovery theory, and certainly tells us that the stock market went ahead of itself to the upside. Disney Resorts, or Disney in California, is extending its closure. They're not going to open until after July, at least. And this is the dilemma that we're seeing with reopening, whether it's resorts and casinos or restaurants or bars, because once you have a positive case of infection among your workers, you're going to have to shut the whole joint down. The market started by gapping down, but was quickly bought and hung around throughout the day before catching a major bid during the close. The reversal here can be attributed to a major headline. This is the most important headline of the day. We learned that the Federal Reserve and financial regulators have eased the Volcker rule on banks. Now, if you're not familiar with Volcker rule, it's part of the Dodd-Frank reforms that happened during 2010 after the financial crisis. And it basically limited banks from gambling activities and very risky hedge fund-like activities. It's not enough that the Fed lowered the capital reserve requirements. So the banks were regulated and required to have certain amount of reserves so they can survive in a stress event. The Fed, because of the coronavirus crisis, said, all right, we're going to lower those requirements so you can make more loans and free up more liquidity to make revenue. And now they're easing the Volcker rule. I will make a video during the weekend in details of why the reversal on the Volcker rule is really bad news for the economy, because it is the first step in creating the financial crisis 2.0. It is not enough that we have Great Depression-like unemployment numbers and a pandemic. Let's sprinkle a little bit of financial crisis on top of that. We've also seen reversal early on in the market in terms of the airlines and cruises and all the weaker stocks, along with the banks, caught a bit. And I put up this tweet warning that don't jump on the bandwagon of buying airlines and the cruises and the rest of them, because this could be short covering. Shorts made big gains, shorting the airlines and cruises and oil, banks, all the weaker industries, weaker sectors, and they're probably taking profits before the end of the week tomorrow. Here is a daily chart of Apple stock. Apple reversed today and had a gain of 1.3%. Still, we can't make a conclusion here if it's going to blast to the upside again or do what we expect of catching up a little lower to the moving average, the 20 days moving average right here in orange. I have an update for a trade I showed you 2 days ago of a put option that I opened on Apple expiring next week. This position was actually up big yesterday, but lost about half of the gains from yesterday to today. It's still up for me because my entry price was $180. So here's the update on the trade. Today, early in the morning, I opened a trade. I sold the 347.5 put expiring this week, meaning tomorrow, Friday, and I sold it for $100 per contract. That makes my entry price, I paid $180 for the 350 put expiring next week, and I sold the 347.5 put expiring this week for $100. So my all in all entry price is $80. The point of trades like this is to lower your entry price as much as possible. I expect the put expiring tomorrow to expire worthless, and then I'll have to look at next week activities and see if Apple will continue to drop or not. But again, I lowered my entry price as much as possible, and now the trade has higher probability of ending up being profitable. Another example of minimizing your risk, here's another trade I opened yesterday on MGM Resorts. It's a short, it's a put expiring next week for the $16 put, and I paid about $34 per contract. Today I sold the puts expiring this week, the $16, so it's a calendar put, and I sold it for $30 per contract. So all in all, I paid $4 per contract to enter this trade. I am lowering my risk as much as possible, so I don't have to worry if the stock is going to make the move that I'm anticipating or not. likelihood is MGM will by next week, but I am increasing the probability of profitability as much as possible and lowering my risk as much as possible. Constructing an option trade is an art, and the main goal is lowering your risk. A lot of people open short-term trades expiring weekly, and they buy out of the money, way out of the money, and expecting a wild shot to happen. This is gambling. It's not really trading or investing. When you construct your trades, you have to come in the trade with the mentality of lowering risk and increasing the probability of the trade being profitable. So let's look at what happened after market. Important, very important update. The Fed stressed results are in, and they don't look good. Maybe easing the Volcker rule was a sign in the morning that the stress test results are not going to be good. The Fed pretty much capped the dividend on banking stocks. They cannot increase their dividend because banks are not in a healthy position right now to increase the dividends. So all the YouTube bros that you guys are listening to and the geniuses on television who are saying, hey, buy the banks, buy bank stocks because dividends will increase and dividends are good. Here you go. The Fed capped the dividends. Banks cannot increase their dividends. Also, the Federal Reserve is asking banks to resubmit their payout plans. This is the first time it happened since stress tests started in the banking sector. Not a good sign. Something is brewing in the banking sector, and it's certainly not good. What are they trying to hide? Finally, what should we look for tomorrow and next week? We're still struggling in this range right here. We broke the positive trend, and we're struggling here for a resolution. The longer we struggle and not pop to the upside and close above these levels here where we broke from, the more I'm thinking that this is a negative scenario. Because when you consolidate on top of a trend like here, you're basically gathering energy and inviting more buyers to take a ride to the upside. When you hang out around here after a breakdown, you're basically gathering energy to get more sellers to the downside, because what you're doing initially is the market inviting buyers, any buyers, going once, going twice. Buyers are not showing up. They're just buying dips and trading in daily trade activities. So what happens is sellers will get frustrated and they're like, all right, let me take some profits here and sell. And you're going to see a breakdown to the downside. This is the way I see it, at least for now. And I see the pops in the market like today as opportunities to sell and take profit, and in certain cases to short. If you found this video helpful, please subscribe, share, like, and follow me on Twitter.